next week's Fed meeting could be the bottom for gold and silver.
Stack gold and silver. Be the bank. I've been chanting those lines for years on my YouTube channel, and it has never rung truer than today. Buy your precious metals online from SD Bullion. New customers get gold and silver at spot by visiting sdbullion.com/new. Hey everyone, thanks so much for watching Yankee Stacking. I'm recording this video on Monday, March 13th, and gold is up. Silver is way up. Why? They're protecting us against failing institutions like banks. Well, what really happened with Silicon Valley Bank? Where does the blame belong? And what does this silver and gold stacker think is coming next? Well, for that, I asked Lior Gantz to once again join me for a rundown. Hi, Lior. How you doing?
I'm doing good. Thank you for having me.
All right. I want to cut right to the chase here, Lior. Tell us, first, what happened late last week, specifically with Silicon Valley Bank? Second, who's to blame? And third, what's going to happen next? So first, What happened?
Yeah. Very simply, Silicon Valley Bank is a banking institution that works primarily with startups, VC clients, and Silicon Valley type clients. So could be firms, could be individuals, could be funds, etc. They had about $200 billion worth of deposits. They had $14 billion of cash on hand in case some of the depositors want their money back. That's what they keep in very short-term or liquid cash. Then they have short-term securities. These are securities that have either a 1-month hold, an overnight lending, very short-term, so they have that on hand in case there's a little bit more. But then they had $100 billion in very long duration mortgage-backed securities and treasuries. Silicon Valley Bank bought $100 billion worth of treasuries at 2% interest rate, and now interest rates have risen to 5%. Then that $100 billion is not worth $100 billion anymore, even though on the balance sheet it still shows $100 billion. And the problem it starts to occur when they have to start liquidating that position that's not worth $100 billion anymore. On Wednesday, their management said, "Hey, we're going to raise capital." On good days, in other words, if this was a bull market for tech and everything was all right, they would probably have gotten away with it. But that announcement, out of nowhere, because nobody thought there was a problem before, very few people even talked about SVB as a problematic bank, that created a classic run on the bank, literally a classic run on the bank, where in 48 hours, a 40-year-old banking institution went belly up.
I saw that it had been rated by Forbes about a month ago as the best bank in America, and now it's gone.
And Moody's gave it the highest credit rating.
Yep.
Up until the day before.
Okay, so Moody's, there's Moody's for you.
But there are other banks that are sitting on huge unrealized losses. The big four are sitting on about $650 billion.
Wow.
Billion.
I read that 8 years ago, the CEO of SVB Financial Group went to Congress, along with others, and said, "Hey, we're not a too big to fail bank. We're not I think they call it a GSIB, Global Systemically Important Bank, I think it's called. Yeah. You don't need to make us have to go through hoops with compliant costs. We shouldn't have to pay that. We shouldn't have to do all these stress tests." And they got what they wanted.
Yeah. The regional banking sector, as opposed to the big four, in the aftermath of 2008, because of the consolidation in banking, a lot of banking executives, investors, shareholders, board of directors, they said, "Hey, this is a very uncompetitive business." Basically, you allowed 4 banks to take over the entire banking system. So if you want us, the regional banks that employ mom and pop, that operate in their own regions, if you want us to flourish, you need to set us apart in terms of regulation. And unfortunately, it backfired on them big time. Now, it doesn't mean that all regional banks are like this at all. Some are very conservative and have very prudent management teams and portfolio managers. But I mean, this was gross negligence.
Right, but the federal government does share, I think, some of the blame here.
Absolutely.
But I think the Federal Reserve owns an even bigger slice of the blame, Lior. Their monetary malfeasance with, the low interest rate policies they've done for so many years created a moral hazard deep within the banking system, and especially with some banks like SVB. They artificially incentivize bankers to hold U.S. Treasuries as a Tier 1 asset to bulletproof collateral. And then the Fed raised the rates at warp speed. They hoped and prayed for a soft landing, and then they broke the system. And I knew they were going to break something. Our central bank shares a great deal of the blame.
I agree from a different perspective as well. It is such an easy exercise for the Fed to call the bank and say, hey, we need to look at the books. It's going to take us 48 hours. When's the last time you did a mark-to-market? And let's see your bond portfolio because we've been raising interest rates. Everybody's at a loss. The Fed itself is sitting on major losses.
That's true.
We know what you're going through. Could you please show us your books?
Yep.
So we can solve this. We have overnight lending. We have repo. There's so many facilities we can help you with. Are you in trouble?
The bank itself, SVB, shares quite a bit of blame. They took their customers' deposits loaded up on, like you said, long-term treasuries, mortgage-backed securities. They had an obscene lack of diversification. And again, when the central bank raised rates, they got hammered. It's mismanagement at a massive level.
You literally are designed as a bank to manage risk. That's your primary goal, is to manage risk. So the first blame is internal. Always. You have to look within.
Okay. I'm going to say one more that is probably not going to be popular, Lior, but I believe that bank depositors share a small slice of the blame pie. They're culpable too. The moral hazard that I talked about with the government and the Fed, I think that has caused a ridiculous amount of apathy over where people put their hard-earned money. Lior, people care more about their online banking options or having quick access to an ATM than they care about their bank's investment portfolio, their solvency.
So I agree with you. Depositors obviously share in the blame. Now, the way that they share in the blame is not direct or easy to quantify. In other words, it's not like you call a banker in your bank and say, "Hey, guys, should we be worried about our deposit?" You don't do that every day. It's not part of risk management in America. Nobody does that. Depositors will now have to have some sort of defense system to where this happens. The bank controls your money. When the bank, this is reality, when the bank invests in treasuries through BlackRock or Fidelity or whatever, if you're the depositor and you call BlackRock or Fidelity, they tell you, no, that money is the bank's. You call the bank.
It's not yours.
Right? It's not yours.
Right.
It could be your bank account, but it's not your money. So I think that it's a complicated situation, and it will be interesting to see what comes of it. The bank is to blame, the Fed is to blame, the government is to blame, the depositor is to blame, etc. But I don't like blame. I like what's going to happen from here on.
Let's talk about what's next, Lior. The Treasury Department, the Fed, the FDIC, they all made statements designed to shore up wavering confidence in our banks. Everything is awesome. It's fine. Nothing to see here, right?
Yeah.
The FDIC said they were going to make all the depositors of SVB whole. 100%. That may be great news for the 97%, I think, or more that had over $250,000 worth of deposits at SVB, but they're making some big changes, aren't they?
Every time I hear somebody saying, hey, they're making the rules as they go along, they're moving the goalpost.
Yeah.
I have never seen a situation where the goalpost has been static. It's always moving. They are always changing the rules. That's just the problem that people have. They think that they come into this very orderly system
and static and
yes,
but and they come up with new buzzwords and new funds and new programs,
and they choose winners and losers, right?
Mm-hmm.
Like you could have saved Lehman, you let him go. You saved other banks. You could have, it's very, it's not fair. The way the Fed operates is it raises rates until something shows it that it's done too much. Otherwise, they can only guess that they've done too much. It feels like the hard landing is probably real, and therefore the Fed is probably going to change course in March. The Fed meeting next week, they're probably going to say, "Hey, we're moving into a wait and see approach. We're not saying no to more interest rate hikes, but for now, it's not on autopilot. We don't know, etc., etc." So I think that they're not going to close the door on it, but essentially they'll say enough so that the market understands that they've closed the door on it.
And what will that do with gold and silver, Lior?
Well, it's already doing it.
This may sound radical to you, Lior, but I've been saying to people, be the bank, get excess savings out of the public bank. Again, sounds radical to some, but I just don't buy the con game that I see in the banking cartel. Virtually every bank in the Western Hemisphere is holding the same debt to a greater or lesser degree for the same reasons.
Correct.
And no one seems to see the risk, or hadn't up to this point. But you mentioned insurance companies. How about pension companies or pension funds? Pension funds, they're all stuffed to the gills with risky treasury debt, state reserve accounts. Yeah. They're so-called rainy day funds. Lior, we are chock full of long-term treasuries all throughout the economy. And those losses are piling up.
The risk is there. There is definitely risk when you change from zero interest rates in 18 months to higher interest rates than historical interest rates in America. Mm-hmm. We're higher than the historical norms. Now, inflation is not the biggest worry, and they will, as the market thinks, they will probably raise for the last time, and it will probably be at 25 basis points and not a 50 basis point, as was projected just last week.
I know. I think, Lior, they're going to give up this so-called fight against inflation because this is so big. They have to respond. And I think we, as investors and as stackers, need to respond as well. I hope people have been stacking gold and silver, physical precious metals up to this point. It's acting like the hedge of protection that they are. Lior, I wouldn't be surprised.
Man, if they cut silver's,
well, if they cut,
it's going to close, and the dollar is going to be weakened.
The dollar might tank. To be honest,
it might tank.
I think we're going to see some incredible action in gold and silver over the next months and years ahead. Lior, thank you so much for that breakdown. That really explained a lot.
Absolutely.